I think the event or the response to events is that we see a failure to deliver because there's so many paper contracts out there per real deliverable ounce that it's a certainty that there will be a failure to deliver. That failure to deliver, I mean, you're talking about triple digit silver with maybe a fair sized number in front of it, $400, $500, $600, who knows? You just have to understand that the price of silver has been suppressed for so many years with naked paper contracts, and the game just kept going and going.
Many investors believe that the gold market is deeply manipulated through mechanisms such as central bank leasing and naked short selling on the Comex exchange. This has contributed to a growing disconnect between the physical availability of gold and the volume of paper claims on it. The core concern is that there are far more paper contracts than actual bullion available to fulfill them. As confidence in the paper gold system erodes, a potential collapse could send gold prices soaring. Financial commentator Bill Holter warns of a looming risk, a failure to deliver scenario, where even a small percentage of investors demanding physical metal could trigger a systemic breakdown, not only in gold and silver but across the broader derivatives landscape, including oil, wheat, and other commodities. Such a failure would expose the fragility of the current system and could lead to massive price dislocations. Last year, private Chinese citizens rushed to buy physical gold, overwhelming the Shanghai Gold Exchange's ability to meet delivery demands. This rare shift highlights the growing demand for tangible metal over paper claims. Silver is facing similar pressures. Manufacturers, particularly those in the solar energy sector, have been aggressively purchasing physical silver for use in photovoltaic products. Physical demand has surged in markets like China and India, further tightening already limited supplies. Holter argues that in a market where delivery becomes unreliable or impossible, traditional supply and demand dynamics break down entirely. This could drive silver prices to unprecedented levels, not just three-digit figures, but potentially $400 to $600 per ounce or more. In such a scenario, the scramble for physical metal would reflect a broader collapse in confidence in the paper pricing system. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, the price of gold has gone higher from an institutional standpoint. You've got institutional buying, you've got hedge fund buying. Most importantly, you have central bank around the world buying. Oddly, and I mean, you couldn't have told me this scenario 2 years ago, 5, 10, 20 years ago, that the world would be on the verge of World War III and the public would be selling gold. They're selling gold, they're selling silver. And I've seen more sales in the last 6 to 9 months, just in my own personal book, in the last 9 months, I've seen more selling than I've seen collectively in the last 15 years. That tells me that there's no money on the streets. That tells me people, the average person, is running low on funds and selling assets. And of course, you know, what asset are you going to sell? Something that doubled or something that's down in value? So you've seen gold, you've seen silver from a retail standpoint has been sold to raise capital, but from a central bank standpoint, they're unloading it left and right. Oh, and one other thing, Jesse, I want to mention that, and I started talking about this probably 10 years ago. It seems to me that, I mean, obviously paying the debt back is mathematically not possible. There's no way you can pay the debt back in current dollars. And I said all along that there would be a point in time where they would kick the table over. And they kick the table over because they know that they can't hold the system up any longer. So they start a war, some type of false flag, whatever. They kick the table over and they say, well, our policies were sound, our policies were working, except for, you know, this or that or whatever. And they'll have something to point at to blame rather than the structure of the system. I mean, there's all kinds of potential events. I think the event or the response to events is that we see a failure to deliver, because there's so many paper contracts out there per real deliverable ounce that it's a certainty that there will be a failure to deliver. That failure to deliver, I mean, you're talking about triple digit silver with maybe a fair sized number in front of it, $400, $500, $600, who knows? You just have to understand that the price of silver has been suppressed for so many years with naked paper contracts, and the game just kept going and going. It could have easily been blown up by Russia. It could have easily been blown up by China, but that would be an act of war. And they basically left us to our own methods of destruction, of destroying ourselves. And that failure to deliver is going to happen. And when that happens, it's going to set a time bomb of derivatives defaulting off. I mean, that will be the end of the financialization of the West. You can't forecast a price if there's no supply. I mean, it will end in a failure to deliver. And look at the price of gold, look at the price of silver, much, much higher than they were 6 months, a year ago. And all of those shorts are underwater now. All the shorts in silver are underwater. All the shorts in gold are underwater, which means they've got to be meeting margin calls. And okay, so the money gets printed up and maybe even lent to the shorts, but it's not going to make any difference, because at some point in time, the herd will move in unison and say, I want my metal. I don't trust a paper contract. My late partner, Jim Sinclair, used to always say, what is the value of a contract that cannot perform? And the answer is zero. And if you're zeroing out contracts, I mean, he was talking about, you could see Comex gold, $10 offered, $10 offered, no bids. And you could see it in the cash market, $50,000 bid and no offers. And that illustrates the value of a contract that cannot perform. It's worth zero. But that's going to bleed over to the entire derivatives complex. I mean, what does that mean for oil contracts? It's going to push the world more or backwards toward cash and carry trade, as opposed to the financialization where paper contracts can push the price of an asset around to fit whatever the current narrative is. And I would just say that gold and silver are money, and historically, when the shit hits the fan, you want to be in cash. In the old days, 100 years ago, cash meant dollar bills or a currency that was backed by gold or exchangeable for gold. That's no longer the case. Going to gold, going to silver is going to cash. And that's what you do before recessions, before World War III, whatever. You know, if you're trying to hide, you're trying to find a safe haven, gold and silver are the ultimate, because they cannot bankrupt.
Yeah.
And that's the bottom line, is they can't bankrupt in a world that is bankrupting.
Economists have cautioned that the new tariffs could push up costs for businesses and lead to higher prices for consumers, potentially reigniting inflationary pressures that had been easing in recent months. Despite these warnings, the White House remains firm in its stance, arguing that foreign companies, not American consumers, will bear most of the cost and that the tariffs will ultimately benefit domestic industries and the broader economy. To support this narrative, the administration has paused some of its more aggressive tariff plans, allowing room for negotiations. Still, early signs of inflationary impact are emerging. The latest consumer price report showed prices rose 2.4% in May compared to the previous year, a slight increase from April's 2.3%. While the impact on household budgets remains relatively contained for now, it has been most noticeable in categories like appliances, where U.S. supply chains are heavily reliant on Chinese imports. Bill Holter offers a more alarming view, warning of eventual hyperinflation, driven by the fundamental instability of the current debt-based financial system. He argues that this system functions like a Ponzi scheme, requiring constant expansion of the money supply to survive. In his view, the repeated reliance on monetary stimulus and deficit spending will inevitably lead to the dollar's collapse, triggering a surge in the cost of essentials, such as food and energy. This, he believes, could make recent inflation concerns seem mild by comparison. Let's get back to the interview.
Oh, we will see hyperinflation. You're going to see, and I've talked about this for at least 10 years, that we would see deflation of the things we already have and inflation of the things we need to live. It's a certainty that the dollar will lose value from here because the interest doesn't exist to pay. So they're going to have to. I mean, we're going basically to the definition of how the system works. When money's borrowed, the interest doesn't exist, so that interest has to be printed or created. I think the bottom line is there cannot ever be a real cut in spending, because you can never shut the new flow of funds off to a Ponzi scheme. And this whole system, the whole fractional reserve system, is a Ponzi scheme by definition. And you can't shut new money off. If you do, the old money that's already invested withers up, dries up, and dies. The bottom line is you've got to prepare to protect yourself. You've got to prepare in the way of having food, clean water, energy if you can. You need to be in a location where, you don't have 100 neighbors within 50 yards of you. You need to be in a rural situation where you can protect your position. How do you protect your position? You need arms. You need ammunition. You need to try to get yourself in the most self-sufficient position that you could be in, because you're going to dial 911 and nobody's going to answer for a spell. Is it going to be 2 weeks, 2 months, God forbid, 6 months or more? We go 6 months or more where the system is down, where banks aren't open. You can't go to Walmart because there's nothing there. It's closed. You're going to see a lot of people die. I mean, the knowledge of how to survive off the land now no longer exists. If you go back to the Great Depression, what was it, like 80% of America were still had the tech, or had the knowledge of how to farm, how to feed themselves. That knowledge now is what, 5%, 7% of the country. Absolutely. I mean, the biggest positive is the border and the deportations. You've got a lot of people that argue that, but me personally, I think that's excellent. I think the business dealings that he's done, like the crypto stuff that he did, he's going to run it through AT&T or whatever. I just think it's all a bad look. I questioned the first day I heard it about the anti-Semitism laws that they want to put into place, where if you say anything bad about Israel, you go to jail. Well, what about the First Amendment? I mean, the First Amendment is supposed to be ironclad law in the United States with no exceptions. And what are they doing here? Oh, yeah, there's a First Amendment unless you talk about Israel badly. I think that's really bad. I also think that the timing of the Israeli attack a day or 2 days before the peace negotiations that were going to be held on Sunday. I mean, it's not only a bad look. That's just plain bad. That's like somebody punching you in the head while they're shaking your hand at the same time. That's Pearl Harbor stuff. People don't wake up until it affects them personally. I mean, if people woke up and in a week's time realize they've got 25% less capital than they had the week before, that affects them. They go into the grocery store and there's no cans of tuna fish to buy. That affects them. We have a real estate. We've already had commercial real estate has already begun a humongous collapse. Not so in the housing market. The housing market, the only thing that's happened is the volume is dried up. The volume now is about 50% of what it was a couple of years ago as far as sales, as far as closings. The next thing will be price drops. That affects people mentally, and it affects them financially, but more so mentally. If you think your house is worth 2/3 or 3/4 of what it was. So my answer to that is basically no, nobody's going to wake up until it affects them personally.
As doubts deepen over the reliability of paper-based commodity markets, a growing number of investors and manufacturers are shifting their focus to physical assets. The strain on delivery systems, whether for precious metals or critical industrial materials, reflects not only rising demand, but also a loss of faith in the credibility of synthetic pricing mechanisms. Meanwhile, broader economic risks, ranging from supply chain vulnerabilities to monetary policy distortions, continue to build. If confidence continues to erode, the resulting market dislocations could redefine how value is measured and protected in a fragile financial environment. Are we approaching a tipping point where real-world scarcity overrides digital convenience, forcing a reckoning in global markets? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.